Hit it.
It's Friday, March 14th, 2025, episode 260. I'm Patrick Serezna.
And I'm Kevin Muir. This week, we welcome to the show COMEX and NYMEX veteran and author of the Market Vibes letter, Johnston. We have a great discussion about his career on the floor. We talk about the silver squeeze of the late 1970s and then find out what he is buying and selling today. Then Patrick regales us with his technical analysis wizardry in talking charts. And for those who are interested in learning more about Patrick and his team at bigpicturetrading.com, make sure you go to his website and register for the completely free webinar on March 18th, Stock Repair Strategy Using Options.
All right. Well, thanks for the plug, Kev. I have no beer. I have no beer. No explanation. I apologize. Anyway, we're going to just have to go straight to the disclaimer.
All right. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the recession risk reverberation. I was worried about actually saying that one, Patrick, but I did a good job.
You pulled it off. You pulled it off.
Volatility vacuum vortex and the short squeeze spasm.
Which is going to happen soon at some point.
All right. Let's get to the guests. All right, it's our great pleasure to welcome to the show Johnston, COMEX and NYMEX veteran and author of the Market Vibes letter. JJ, as you're well known, thanks for coming on.
Thank you. Good to be here.
Before we start, I have to say something about your background. And for those that are listening, JJ is writing or talking to me from one of the coolest rooms I have ever seen. I feel like you're in medieval England or something like that. Or no, I should say actually 1800s New York. What is that room? Tell me a little bit about your background.
So I'm in a house which was designed by Thomas Edison.
Oh,
and it was the residence of a guy who invented Dr. Scholl's insoles. Right?
Yeah.
So it was built in 1908. It's the construction is an Edison invention where it's the foundation is cut out of the ground, a cage, rebar, and its shell is built for the 3 stories that it is, and then the entire structure is poured solid concrete top down in one pour.
Oh,
so all of the ancient intricacies, whatever they had as technology in those days, are trapped inside 2 feet of concrete walls.
And whereabouts is it? Where is it? New York or is it? Or where are you? Like Connecticut or something?
Yeah, in Morristown, New Jersey. Yeah.
Oh, New Jersey. Okay, got it.
Right.
All right. So why don't we learn a little bit more about you before we start talking about markets? And you do have some great stories, and we're gonna have a lot of fun. But a little bit about yourself. Where did you grow up? Did you always think you were going to end up on the floor trading? And how did the early part of your life develop?
Well, I came from an upper middle class family. Went to private schools, got a pretty good education. My mom and dad were divorced, so I was bi-coastal. I, spent some winters in California, summers in New York City and upstate New York. And
that's pretty nice.
I went to the first job I got on Wall Street was I was a runner, and
did you go to university? Like, did you?
Yeah, I went to University of Arizona.
And what did you study there?
Liberal arts.
Mostly
art history. Russian lit, which is where I picked up the name Alyosha, and that's a Dostoevsky character.
Okay, and so you go study, this the liberal arts background in Arizona, and then are you just looking for a job, and you're like, I just need a job, I'm going to go to the floor and go work there? How does that work?
Well, it was not a really interesting story, but I didn't get along very well with my father when I was young. I 60s guy. It really wasn't really. He was a military man. Officer, followed Patton in the Second World War.
Oh, geez.
And so, we, as I say, we kind of bumped heads. But when I was in my 20s, I had to kind of rescue him down in the Caribbean because he was drinking a lot of gin and eating raw chicken in a hut somewhere.
Oh, my gosh.
Yeah, he had a lot of money, so he could do whatever he wanted. Anyway, I brought him back to New York, put him in the hospital. When he got better, he and I became roommates in Gramercy Park.
Oh, okay.
Right. And got to like each other. And so
I feel like that should be a sitcom.
Yeah, not quite Sanford and Son. Anyway, so he ran an ad agency. His father, my grandfather, was a very successful financier in New York City, and around the World War I days, he was one of the most successful bond salesmen in the nation. And he ran a bank called the Hanover Bank.
Oh, I know it for sure. Yeah,
he became Manny Hanny.
Yeah,
he stayed on the board of that institution for the rest of his life, actually. Anyway, so me and my father were trying to figure things out. Probably 23, 24 years old at the time. And he said, well, money's made where money is. And he helped me get a job as a runner from one of his pals who was a specialist on the stock exchange.
Okay.
So I segued out of that to a better wage, $90 a week for Continental Grain. And they had a startup in those days called Conti Commodities.
Okay.
Which was one of the first, retail futures brokers that took in specs.
Okay.
So the guy who ran that sponsored me for a Series 3. And
so what year is this?
1970, 75, 76.
Okay. So it's early. And it's the heydays of the pits. It's wild. You're there. Eventually you go and you start trading for yourself. And
yeah, so I made a little money. Actually, I made quite a bit of money as a sales guy in 76, 77.
Okay.
And I bought a seat right away. The first thing I did, because I had to go to the floor a lot when I was a runner.
Right.
There was the Cocoa Exchange on John Street, Cotton on Wall. The Merc was over on Harrison.
Yeah.
And I was running checks uptown, downtown to all the exchanges, making margin calls.
You must have been a well-liked guy showing up saying, you got to sell some money. You got to come up with some money. And that's funny that's how you did it. You did it like actually showing up at the exchange.
Actually, yeah. I work for a ex-Marine Corps guy, sergeant, actually. And, I had to show up early and he'd say, get your ass up to Park Avenue, get those checks and get down to the Cocoa Exchange. Okay. Otherwise, we're going to sell these guys out. Right. So that was a perfect job for me.
Okay. So you buy this seat and you have this story about how you got your start in terms of, because like buying your seat is one thing, but you still need some money to trade. And I thought this was just the most touching story in terms of what the other members did in terms of funding your account.
Oh, yeah. Well, that was interesting. You have to kind of work your way up. What I did is I took my sales business to the floor. No one ever did that, and I was able to get some banks. And nothing makes you more popular than success, particularly in that environment. So, you're feeding everybody, they're feeding you, you're taking good care of them. And when I bought a seat and I went in, I was sponsored by some guys that were very respected. And you want me to tell you about how they came around and gave me money?
Yeah. I love this story. I thought it was just like, I felt like, I don't know. It's like, I don't know why. It just seemed very unusual. Not what I expected. And it was a great story. So please.
It's kind of a ritual. In those days, the exchange really wasn't a bunch of geniuses. It was a guild, and trading was not visionary or anything like that. It's a skill. Your job was to make prices. And so locals, and this is before we had Bloomberg and I don't know, technology or anything like that. Your job was to, if someone was asking for a quote, you made the quote, right. How's these, right? 10 minutes, 20. And they say sell 50. Well, I don't want 50. I'll take 10, right? Then I'll be like even bid.
Yep.
And okay, sell you 40 more. So what I'm doing is I'm getting the edge. And with that edge, everybody, traded a lot, traded with each other, and just, tried to make a little money, and if I didn't really want to buy them, I wouldn't say anything. Right. Or I'd just show an offer and then, no one would trade with you. Yeah. That was the way the flow went every day. We opened around 9:00.
You guys are
and
lazy there.
closed, I think, at 3.
Yeah.
That was it. When gold closed, if you were long or short, you were
overnight. There was nothing to do until the next morning.
Right. So most guys, including me, learned how to trade flat.
Right.
You had a day, you made money, you lost money, or anything like that. Every day's a new day. Although there were charting services that we subscribed to that came in the mail, and we could update them with a pencil.
Okay, but tell us the story about how they funded your account.
All right. So, I started out the first day, I had to do a few orders and so forth. But at the end of the day, some of the guys came around and they said, here, I'm going to sell you 10 at this. I'm going to buy 10 here, be $500. Another guy came over and he, did about the same thing. One guy gave me $1,000. His name was Johnny Izzo.
Yeah. So everyone just came in, did trades that were automatic winners for your account, stuck them in your account.
Yeah, they were.
So that they funded you. And then they left you with one piece of advice. What was that?
You'll never be poor again.
Yeah, but they also said never put money into your trading account, which I was kind of shocked about.
I remember who said that. Maybe it was Johnny Izzo. Anyway, he said a couple things. He said, this is your money. Never put money in a trading account. You only take money out.
Yeah.
Only take money out. If you're putting money in the trading account, you really have to step back and think about what you're doing. Maybe you shouldn't be doing this. And that's true. You shouldn't actually. So, and then he said, you'll never be poor again, kid.
And so this was in the late 70s. And I guess you were in the silver pit for one of the most famous episodes of all futures tradings ever. And that was the Hunt Brothers Corner in Silver. And I was just, to prepare for this, I went and grabbed the quotes just so people understand. Because I don't think that there's not a lot of folks that remember it, and you probably just can't appreciate it. So I went and looked at it at the end of 1978, at the end of 77, silver was 4 3/4.
Yeah, bad.
At the end of 78, it was $6. At June of 79, it was 8.5. September of 79, it was 16 1/4. Don't forget, this was 4 3/4 just 2 years earlier.
Yep.
December of 79, it was 32.20. January 15th, it was 44. January 18th, it was 49.5. February 1st, it was 35. And then March, it was back to 13. And then December 1980 was 15. And then December 1981 was 8. So that has got to be just one of the most wild periods ever. I would just love to know, what it was like being there. Any stories, any color you could share about that period.
So I worked for Norton Wooltuck, who was probably, if not one of the most important players in that squeeze. He was my original boss. He hired me. He didn't hire me. Harry hired me, but he sponsored me for my Series 3, and I was working at Connie Commodities at the time. That's pretty green. I had made by that time a lot of money, not even knowing what I was doing, because I did what everybody else did, and it was easy to make a lot of money. The guy I stood next to, his name was Frankie Lisi in the Silver Pit. He also worked for the same guy that I was in his booth, a friend of kind of an incestuous relationship. But at any rate, Frankie. He was just a regular guy, an Italian guy, a great guy, floor trader and so forth. I don't really know how much he made, but I know that he lost $4 million one morning on the opening. He had, when you're making that kind of money.
Yeah, but not only that, just to put this in context, folks, this is in the early 80s. $4 million is a lot of money.
This is, I guess it was January, because what had happened, I went to Aspen the weekend before with some guys, right? And we were all, drinking, playing backgammon, and for like $1,000 a point, $20,000 games and things like that. And so I came in the next morning. Frankie was long a bunch of sugar. He was long a ton of silver, and silver had gone liquidation only.
Can you explain to people what that is?
Well, yeah, the squeeze was from the longs, and there was no silver. And I think Jarecki was the guy who was able to get the exchange to get it through its head that if they allowed this thing to play out the way Norton and the guys in Brazil were going to, and the Hunts and so forth, were going to make it happen, it would have been the end of the exchange.
Okay.
It would have been catastrophic for futures, and it may have like taken down some really big banks, because the cycle of the silver was to buy it on the exchange where there were no limits.
Yeah.
Receive all the silver because you had to deliver a default.
Right.
Send the silver to Zurich, collateralize it, get the cash, buy more futures, receive the silver. And that went on, both with the guys in Texas, a click in Brazil, our guys in New York.
Yeah.
And Norton was the guy, my boss, who was the guy who was going to the floor every day. And, silver was like, just pick a price, 20, 21 and a half, 22 or something like that. He'd just come in and he'd say, I'll pay 25 for 5,000 lots. So
come on, really?
Actually, this is true. He would, well, maybe not 25, 23, 24.
Yeah.
It was so regular.
He bid it through to get size.
The guys on the floor paid guys to stand by the elevator banks so that they could, run up the stairs, get to the pit, and let them know that Norton was coming to the pit.
Wow.
And he wanted us to load up for him, right?
Yeah.
He didn't want to stand in there and like go, I'll take 10, I'll take 20, I'll take 3, 6, 8, 2. I'll sell you one, He wanted to get hundreds at one time. And the best way to do that was to get us long.
Oh, so that you guys could show him an offering. So when he walked in there and went 24 bid, you could sell him 1,000.
Well, if your clearing member would let you put that kind of size on,
whatever the number was, but okay, 500 or 200 or whatever the number was, he could trade in size instead of trading in twos.
Yeah. But sometimes it didn't work too, and you get stuck, right?
Yeah.
Maybe Norton was just going to lunch. Anyway.
So this guy lost $4 million on the open one day.
Yeah,
that is just obscene.
I'll tell you why. Because the Merc had this contract silver coins.
Yeah.
And they were bags, right? And so, when you make that kind of money, you think you're invincible, right? You think nothing can happen to you. But the Merc had limits, different limit rules, right? And so our guys, we had limits as well, but we could still get out of silver. Some of them. I didn't get caught long. I didn't have anything long. But it was easier to get out on the COMEX because it was for liquidation. Okay. In other words, the exchange wanted the market to go down.
Okay.
But the Merc was like this parochial old butter and eggs kind of exchange. Their big product was platinum and palladium and potatoes.
Potatoes? I didn't even know those traded.
They listed a silver bags contract, which was quarters and dimes.
Okay.
So Frankie had like a limit position of that. And that just went limit down, limit down, limit down, limit down, limit down. Never traded, just went all the way down. Oh. So he lost money on that day. He was long a bunch of sugar. That came in limit down. Silver went in limit down. And so when, in those days, the market just locked. And there were things called pools. So you had to put your offers in a pool and pray that somebody would come and buy it. And so,
oh wait, I don't understand that. I didn't realize that. I thought you mean you got in line to sell?
Yeah.
Yeah. Okay.
As soon as it went down, you showed offers, and then you could enter volume in a pool.
Okay.
Which
was first in, first out?
What?
Was it first in, first out, or was it random or pro rata?
Yeah, you put your offers in at the rostrum, set out some 50 limit, right?
Okay.
And then you'd watch it, and it could pile up, and you'd watch the pool grow. There could be like 1,000 in the pool, 2,000, 3,000 in the pool.
Oh, wow.
And so you knew nobody was going to buy them, right?
Yeah.
Or if somebody did, they would take them all.
And then you didn't want to sell them.
And then it would leave.
Right.
So anyway, it was pretty crazy. It was pretty crazy.
I'd love to talk a little bit about your story that you wrote called Rites of Passage. And it was a story to your daughter.
Yep.
And I take it that you've gotten a lot of feedback on that. And I was kind of reflecting on why you'd gotten a lot of feedback. And is this one, by the way, do you need to pay for your Substack to get this one, or is this one open to the public?
I think, you have to subscribe now. I mean, it's free. It's free for, I think I leave it free for months. And then it kind of, all those old stories, there must be 20 short stories and stuff like that. It kind of just goes to the bottom of, and people just stop reading them.
Yeah. Well, they shouldn't stop reading this one because it's absolutely fantastic. And it's a story about your daughter that was having trouble making sales because people around her were cheating. And it was just, your advice to her in terms of what's more important in life. And it was really touching. As I was watching your previous interview and thinking about this thing that you wrote, I remembered actually that there was a big sting operation in many of the futures exchanges in the 80s. And because there was a lot of problems in terms of, or I don't know if there's a lot of problems, at least there was enough problems that the FBI actually put in undercover, agents and stuff like that. So I just love to kind of get your opinion about why you wrote that, talk a little bit about your philosophy about cheating, and just kind of the feedback that you've gotten from that.
I actually don't know why I wrote it. It's been rolling around in my head. I've always been a broker who writes, and I write about the markets, and occasionally I write short stories. And I must have written 50 at least. And these short stories that are in my Substack now, some of them I had sketched out in earlier days, and this was one of them. They kind of sat on my hard drive for several years.
Really?
Yeah. And occasionally, I go back and I prowl around in that stuff. Just, oh yeah, I wrote that. That's kind of cool. I like that, and this, that, and the other thing. So after writing on Substack, Substack is intellectual weightlifting. It's a discipline. I get up at 4:00 every morning. I write for a couple of hours, a morning piece, and then I write for an hour at least at the end of the day, an evening wrap. And it really elevated my skills, my ability to select words, language. And so I thought this, and I saw this, and I thought I really like this story I wrote. I'm going to rewrite it. And so I did. Essentially the same. It's for your listeners. It's a story about my daughter and I having dinner at the Gramercy. I think it's the Gramercy Inn.
Yep.
In or around 2015 or 16, she'd just gotten out of school, trying to figure out what's going on in life. She had a job at Yelp in the sales pit. So Yelp was just rising then, stock might be $10 on its way to 100. She'd gotten a few shares of stock, and, she thought that was great, but she was very frustrated because there's tremendous pressure on the sales team, and there are about 100 people in the sales pit to make a quota.
Right.
And being a sales guy, I know what it's not quite the same thing for us, but there's a lot of alpha jerks,
right,
that are willing to say whatever needs to be said, right?
Yeah.
Promise whatever needs to be promised. Close that deal. Move. Do it again. Move. Do it again. And some guys made a lot of money, so she was frustrated and said, I don't know what to do. Everybody lies, and I just don't think I can lie. So we talked about that, and I told her about, my time on the floor, which forces everyone, because it's an honor system. Everything we did in those days was your word. Say a 50, no matter what happens, those trades are going to be good, right? And the whole system on the floor would break down if there weren't that initial, very, very, very high level of honor. And beyond that, you're talking about some of the stings in the 70s or the 80s. guys did things that I didn't want to do. Right. I just didn't want to do them. I wasn't brought up that way. I just couldn't do them. So I told her about that, and I said, this is the way I did it. Find something you can live with, draw that line, stay on the right side of it, and everything will work out for you.
And what I think was most touching about it is also you talked about how it was a difficult time in your life, and it was probably would have been easier to actually choose not a different path. And I think that's what really a lot of people, my guess is that they respond to it is because everyone sees these traders that have done well and they go, oh, that guy probably never had any downs. He's been all up and all, everyone seems to just talk about their winners and nobody talks about their losers or their down periods, right? Like
traders don't talk about their trading.
Well, so that is true. When you get real traders together in a room, like I personally, you won't get me talking about my winners, but I'll tell you a lot about all the bad trades I've done. And I think we're a superstitious bunch and stuff like that. But when you go in this world of social media and people getting up there on CNBC or whatever, it's easy to think that these people don't have never had a down period. And I personally, I'm not a big Bill Ackman fan, but I have to say that the one time I found him the most human was when he talked about how he ran into this problem, in terms of his fund. He says, I was having trouble with my fund. I was having trouble with my life. And he was very open and honest about it. And it was the only time I've actually found myself, liking the guy was when he was, when he became human. And I think that that's also what comes through in this story is your humanness, right? In terms of the vulnerability as traders.
Well, yeah, there were a lot of different people down there. There were geniuses, but they didn't even graduate from 8th grade. They were gifted, and good trading has many parts of it. Some people like famous traders, market wizards guys. They're just one in a million, right? And you're not going to be that. So there are other guys who are steady 10 lot, 20 lot locals, always making prices, always helping out, always eating errors, just good guys, right? And you can make a really good living at that. And so you see that as an example around you. You see them behaving honorably. And then you see other guys maybe not doing things the way you would really do them, and there was a lot of that going on.
Yeah.
The pit is organized like any other anthropological society. It's like a society of apes, what I mean? They're the big, powerful apes. They're the regular apes in the tribe. We have our squabbles and stuff like that. They're the little guys. And every now and then some very successful and gifted person would challenge one of the big apes and he would become a big ape. And that's really it, and the pits were tribal. Traders didn't leave their pits. Gold guys stayed in gold, silver guys stayed in silver. If I went to copper because I wanted to, get along some copper, they'd make room for me. I'd be a tourist, I'd be a guest, but I was a member. They'd allow me to do my business and go.
Right.
I stayed and I started competing for like spreads and legs and things like that. Like, what are you doing?
Buzz off, man.
You're gonna be here, you're gonna stay here, And of course, I had a spot. I had my spot in gold, and moving to a market is a very challenging experience. It can be really expensive, and there's a lot of competition. Where you are. If you grow up in a market, right?
Yeah.
If you write brokerage, if you're a phone clerk, you become a pit clerk, you get sponsored, and you come in under the wing of somebody, you belong, right? You're a known person, and so the honorable requirements of being in the pit in those days had a vetting process. So just to get in there,
right?
You couldn't just come in and buy a seat and say, "Oh, well, now I'm going to put $100,000 in my account," which was pretty much the minimum you had to be self-guaranteed at that time, and go trade. Yeah, that's not going to happen. You know, people they just ignore you. And one of the great rights about being a member in those days was called recognition trading. Like there could be 20 guys bidding, you know, for a spread that was 10-20, and to buy the bid or sell the offer was essential. If you paid the offer and it went against you, now you had to sell the bid to get out. It could be, you know, really bad if you did that on a few hundred lots. So you could pick whoever you wanted to trade with. You get 50, you get 10, you get 85, you get nothing. You know, you didn't trade with me. Why should I be trading with you?
Yeah.
So you were organized in little areas where you had your friends, and on the other side of the ring, you know, maybe there were some guys you liked, but then there were guys you didn't like. And that's just the way life was.
I watched this. Well, actually, not only did I watch the speech that Charlie D from Chicago did, but I also read his book. And one of the things that he always talked about was making your pit size bigger, and how important it was when you were going to hit the bid to make sure you expanded your friends, or you gave it to someone you owed. And that was really like crossing the bid or offer was a chance for you to expand your pit size, was what he argued.
The pit it's just like that, right?
Yeah.
And here's a good example. You want a story? Here's a pit story. So later on in the 80s, I had a really big business. One of the biggest silver books. I'd gone from gold to silver, right?
Okay.
But I was sent to silver by someone. So the silver pit had to respect that, right?
Right.
I was representing someone big. So that's how I got in, but I still had to fight for my spot. So anyway, I'm standing next to this guy, Salicero, who was Jarecki's right-hand guy, a really good guy, a pretty big trader. And so I'm filling this order. It's a pretty big order. And I'm hearing him bidding for what I thought was a piece of size, 60 lots. So I said, sold, you know, but I didn't check it because he's standing right next to me. Yeah. And I'm trading with a lot of guys, and I wanted to get this fill out. So about an hour later, I came back, you know, his clerk and my clerk are there. Hey, you guys have an out. And he was bidding for 16, not 60, right?
Yeah.
So we had a lot out, and the market had already moved like 80 cents.
Oh gosh.
So yeah, it's about 40 grand, maybe more.
Was it you or him that was out?
Well, it was an out, so we had to split it.
Oh, is that how it works?
Yeah, no matter what, you know.
I didn't know you guys split it.
I claimed him on 60, period. That's it. So he had to buy 60. That was it. You know,
you guys split it.
Yeah. So, okay. So then what we did is we got, you know, Julie Brodsky, Craig Efron, some other guys, you know, and we said, hey, we need you to help us here. I think Jack Andolfo was another guy who took a piece of it. You know, the locals, that's their job. So you split up like $50,000, $60,000 error, and everybody gets like 5 lots. So then for the rest of the summer, this is like in the early part of the summer, everything good. You know, if I had to sell 50 Ds, we're trading Julys, it's a widespread, you know, that went to these guys.
I did not know it. That's how you guys did it. That makes sense. Got it.
We paid them back every penny. And that's the way the pit worked.
Okay, so let's talk a little bit past the peak of the pit, because only old guys like you and me will enjoy those stories. Let's talk about going upstairs. And one of the things that, first of all, what was that like going upstairs for you? Like doing the move? I can't remember when the NYMEX and COMEX did it in relation to Chicago. Were you guys earlier or later than them? They were, or the same time?
You mean when we bought the roll up?
No, when did you guys go to electronic trading? Like who was later in terms of keeping the floor alive? Or were you about the same time?
I worked for Refco, and I think it was 2005. They were doing an IPO with Thomas Lee. Yeah, and we all had shares and everything like that. And you know, they IPO'd in September. And the first week of October, I'm having breakfast with a good pal of mine. Did a lot of business together. He worked at Refco, and he said, "We have a problem." And Refco. Phil Bennett who ran the company at that time, had done a $500 million deal with Bauwag in Austria that he didn't disclose during the IPO. And it was a kind of exigent discovery, which invalidated the IPO, and Refco stock closed at 30 on the Friday afternoon before that. On Tuesday morning, it opened at 45 cents.
Okay. But was this the floor trading going electronic? That's what I was asking about.
Yeah. So by that time, it was still electronic, but I got sold to MF Global. I stayed on the floor. I went to ICAP probably around 2007.
Okay.
I had to leave the floor.
Yeah. And it was just because there's no more money there. It was like it was gone electronic.
You couldn't compete,
right?
As an open outcry trader with the electronic markets.
Right. Okay. Right. So I'd love to talk about that, because at one point you tried to go and write yourself some code to actually do what you used to do. What was that like? What was the basis for that? What ultimately did you decide? Like you're writing code in C#. Are you writing to the TT system, like the trading, walk us through how that worked and your thought process and your experience.
So I got plenty of money when I got cashed out by the CME.
Okay.
The seats went for millions, and so I had a COMEX seat, so I had a little over about $1.2 million out of that, and then I had some other money, so I decided I was going to learn to write code.
Okay.
I wasn't going to, start a corn farm or something like that. So CQG, who you may have heard of,
I know CQG.
Top line front end. They were just doing a beta group for a thing called Auto Trader, which you had to write your own systems.
Right.
And so I teamed up with a guy who knew how to write code, and we started writing, taking my trading ideas and putting them into code. And so he taught me how to write in the specific CQG language, which is a form of C#, right?
Okay.
So, you use their symbology, and it reaches down all the way down to machine language.
Right.
And, it does what you want it to. Excuse me. So I liaised with tons of systematic writers. Toby Crable, who used to be.
Oh, I know that. Yeah.
Great
Opening
guy.
Range Breakout, right? Isn't he the author of that?
Yeah,
I got it right.
Those guys, right?
Yeah. Yes.
So, and I showed him my work and so forth. And so he was helpful to me. But, nobody gives away their systems. No one is ever going to tell you why what they've discovered. And a lot of it.
Unless it doesn't work, then they'll be happy to tell you.
So what I found out, really, for all of the hundreds of hours that I spent, trying to grind through data and back testing and all that stuff, is just that the most important thing about systematic applications is just whatever it was.
Okay.
It's past. Right. And there is no certainty about this very next minute, day, week, month, or anything like that. And the most dangerous thing that's going to happen to you is divergence. So, most of the things that you learn are isotropic. That's a big fancy word, $10 word, but anybody who writes code knows what it means. It means that if you do 10,000 trades, at the end of those 10,000 trades, you'll have exactly the same amount of money that you started with.
Okay.
Everything, it's all even. So in the middle of that, you have the cost of execution, you have commissions, you have slippage, and then you have drawdowns, and when you're in a drawdown, it's like, not great.
Yeah. So you did this work, you decided this wasn't it, but eventually you come back to trading because you trade a lot now. And you just decide you're going to go, like, your style must have changed though, right? Because you're in the pits and you're doing some longer term trades, but I'm assuming you're sitting there trading spreads, filling orders, like being a lot more active than you are today.
Yeah, that's completely different now. You can't approach the markets today and survive because you have so many disadvantages. like, for instance, as I said, I was long S&Ps this morning. I was sure it was going to be an up day. I said, just got to figure out how to get in, right?
Yeah.
So I got flat last night, and I didn't want to take anything overnight. So as soon as I could, I saw it wasn't up much. I got long. So we go into, and everything's going great. So we go to this Michigan number, which is never anything,
Yeah.
it's just like nothing.
Not only that, it's seriously 400 Michigan old people that answer their phone. Like, it's a stupid thing to be so focused on. But anyways, the market is. But anyways, go on.
Whatever. So I've never traded with that stop. It can be a wide stop, or it can be a tight stop. Usually I try to look for some kind of safe entry.
And can I ask a question about that? You say, I never trade without a stop.
Nope.
Is it implicit or explicitly in the market?
No, it's in there.
Yeah, okay, that's why I wanted to know. Because some people will be like, no, I hit this, then I work it out or whatever. Yours is like, it's in there.
I thank God every time I'm stopped out. Thank you.
That's a good line. I like that.
Those stops are sometimes the best trades I've ever made. Right? I'm going in for risk. I'm not looking to just like look at a trade, sit there all day. I want to make money. So, yeah, I'm going to put a stop in. And,
Okay.
if it starts going my way, I'm not going to let it get away from me. I've never been a big fan of like, a little bit here, a little bit there, or anything like that. I like to get in, I like to make the money, and I try to have enough discipline to just take it off.
Okay.
I'm not going to get the highs, and if it goes way up and I miss that, well, I might have just held on to it. And when it went all the way down, I may have gotten out lower. I may not have gotten out, right? They give you the money, you win. So, and you learn that, like trading as a local, you have a mortgage, you've got kids in school, you got a wife that likes to make, go shopping, and you can't not make money. Otherwise you shouldn't be doing it, So anyway, I use stops. And so this stupid number comes out, bang. So I got stopped out of the lows, and it just kind of wrecked my day, but it wasn't, I try to avoid, as I said, I look for safe entries, and if I can't find something that, I think is reasonable, I just let it go.
And so when you looked at that and then you get stopped out and obviously then very quickly trades back up, do you ever go, you know what, I'm getting back in even though I stopped out? Or is that like a cardinal, sin of trading?
Yeah, it's kind of a sin.
Yeah.
You had a trade idea, you put it on, unless the market's really moving, right? Like,
yeah. And then it's a new idea though.
So
right? Like
when we were coming down last week,
Yep.
I've been short S&Ps. I hate to admit this because I'm ashamed to say it, but I've been bearish on S&Ps probably since last August, right?
Okay.
I had a killer trade on the 5th of August. I had a load of puts. They came in, I took them all off, made a lot of money on it. I'm up at the river where I was born, and I'm thinking, well, I should probably leave this alone, but I didn't leave it alone. So it started going up. I shorted a little bit, got stopped out, shorted it, got stopped out, shorted it, stopped out. So the period after, I don't know if you remember what S&Ps are like. They had a really big October, so I didn't get hurt there. I read what's going on around me, and I respect smart people. So this guy Rubner at Goldman said, "Hey,
yeah, Scott, yeah."
Right. And when I read that, I think, well, okay, I'm not shorting stocks here, right?
Okay.
Why should I do that? Because all the people that he writes to, they're buying.
Right. So at that point you're bearish, but you'll say instead of getting long, because you can't bring yourself to get long, you'll just be like, I'm just not going to trade the short side.
I forced myself to get long.
Oh, you did? Okay, yeah. Fair enough. Okay.
If I find myself, with 10 trades in a row on the same side of the market, I think, you're in the weeds here, dude.
I like that.
You gotta force yourself to buy this market,
Okay. Yeah.
Right. Just do it. Shut up and do it. So, and
let your opinion get in the way of making money.
Well, you're in our world right now. If you're trading, I'm here in my office alone. I have a bunch of books. I have a lot of memories, and I have some wisdom and experience. But there's no one to talk to, like in the pit. If I kept shorting a market, perfect. Here's a great story, right? So I sell this guy, Frank Mazzara, 50 lots of gold. I can't remember the year or anything like this, some kind of 82 number, right?
Yeah.
And it goes right down to 75. So I'm up like 35 grand. And I'm standing next to this guy, Steve Crivellis, and he's still got that 50. I said, yeah. And he goes, what are you waiting for? What, are you stupid?
Yeah.
So that wounded my pride, and I did not cover. And so,
that's the worst.
7 bid, 8 bid, 9 bid, and I'm thinking, oh man,
really
absurd. So anyway, I got out. I didn't lose money, but I sure left a lot of money on the table. So
that is a good story. I like
the
that.
The reality of that story is if you're in an office, if you're on a trading desk, if you're in an environment that's a human environment, there's no secrets there, right? I sold you 50, that, right?
Yeah.
You bought 2s, it's trading 8. I'm like, yeah. Like, hi, how you doing? If somebody's losing money on a trading desk, it,
Right.
you feel it with them. You're all on the same team and stuff like that. So there's no secrets. So there's conversation, and it's a different environment. When you're alone, it's just you. You have to have the very unbreakable rules of like stops and things like that. Otherwise, you can wind up just having a catastrophic day, right?
Yeah.
So anyway, so I forced myself to go long and stuff like that. So October wasn't too bad for me. But when after the Trump move in November, I realized that rally in S&Ps was like a one-day rally. It went up that day, and it never went any higher.
You're right. It struggled.
It just did this.
And then, do you know what the most amazing part about it was? Even though it was going sideways, people were getting more and more bullish.
Exactly.
Yeah. And it's Kovner that talks about what I really look for in a market is a market that is not price is not confirming sentiment. And that was happening. As everyone got more bullish, it should have been going up, and it wasn't. It was telling you it wanted to go lower.
Well, I thought so. So oh God. Anyway, I thought it was going to happen sooner. I thought we were going to have a serious break in December because we have had some bad, year-end breaks and everything like that. But
we did have a little break. There was a day or two in there. Big spike. The curve went inverted slightly. Like there was a little bit of a sell-off in there, but it was so weak. It was a week, or maybe it was 2 days. I can't even remember.
Well, I bought a lot of puts, and
okay.
Anyway, so I got hurt on that. But I decided, well, screw it. I'm highly confident it's going to happen. Although, I never say anything like that in my writing because I don't want to hurt people.
Yeah.
But there's no question how I feel about a market if you read what I write.
Yeah.
Right?
The other thing is that good traders don't need to be told, I own all these puts. They know. You say I'm bearish. Well, he's bearish. Like he's going to be given a view, or you go, I don't have a view or whatever. Like you don't need to be told I own X number of puts or I am this bearish.
Nothing like that.
Yeah.
Plus, I think if you say you have a position, it's a brain killer.
Yeah, because then you don't want to it's tougher to unwind the trade, right?
You have to defend it.
Yeah. Well, that's the other thing is, right? Well, getting back to Charlie D, one of the favorite stories I have about Charlie D is he makes every trader go out into the pit. He goes, I want you to hit the bid and I want you to take the offering right away. There, you just lost 12 and a half, or what's the tick in bonds in the old days? $32?
31 and a half or something like that.
Yeah, whatever. He goes, you just lost $32. That's how easy it is to take a loss. Don't ever forget it. And I thought that was a really good lesson, that it was interesting that way. Yeah. Okay, so let's talk a little bit about the markets today, what you're seeing. Obviously, you're bearish, but you're a trader. You were bullish today, expecting it. Like, do you still own your mask? Do you still own your puts? And are you trading?
No, I gave up on the puts. Like,
okay,
I hate options.
Yeah.
They're brain killers, right? You think you've got a position, you don't really have a position. You're not short S&Ps, you're long some options, right?
Yeah.
And the market makers literally, they just crush your head. every day. And, you know,
so listen, I can tell you.
I said, screw this. I'm just going to sell some futures.
Yeah.
Plug my ears, hold my nose, and wait for this thing to happen. Right.
Oh, I like it. You're like,
you know, I was in and going down, you know, I tried to trade it, you know, but what I did was, you know, I never got long on this spill because I could just look at the screen and it was just hitting the bid, like, right. And you can tell, like, there's got to be like 25 TWAPs going, all of them, you know, that are gonna fill to close. And it was, you know,
why don't we explain to people what a TWAP is and fill to close, and actually explain to people how that trading has changed in the last, you know, what I would say 10, 20 years in terms of more and more trading is done this way.
No, that's probably the backbone of all box-to-box trading. And, you know, what it is you have a fixed quantity of stuff to buy or sell.
Yeah.
The algorithm will time slice it over a period of time that you want to be executed in. It can be 10 minutes, it can be 2 minutes, it can be a whole day. It can be any amount of size. And you will get a time-weighted fill. So it allows the market to undulate, and, you know, you can capture that without becoming the market. But when you get a market like this one, where Scott Bessent says there is no put on an interview in CNBC, well, that was like, pull the plug. Here's a grenade. And the stock market just went straight down. Everybody said, screw it, we're getting out. And so, and the thing that, you know, was the most vulnerable, of course, were the MAGs and NVIDIA. And so their weighting was so immense, the NASDAQ just put a hole in the bottom of the ship and everything went down.
Okay. So, let's talk a little bit about gold, because that is your like passion. Am I correct? Like, that is what you like talking about the most. Is that what you like trading the most, or are you more a spoos guy?
Well, there's not a lot moving right now except for gold, and it has a very unique way of saying moving, right? It's just kind of like silently floats up, right? So
I agree with you. Why do you think that is?
It's a long answer. I wrote about it in my Substack this morning.
Okay.
And you know, I'll tell you why it is. In the Western world, for all of our currencies here, the most antithetical or threat to modern finance is gold. You know, they don't want people talking about it. They don't want people recommending it. When's the last time you saw Goldman recommend buying gold?
Well, Goldman actually did like a month ago, and that's why gold stalled for a little bit. But you're right. They don't get on TV. Like, when's the last time you saw a big firm get on TV and say buy gold? Nobody really says it.
No great analyst is saying it.
Yeah.
No one's, you know, planting their flag saying gold is bullish. We should be buying gold.
Like, nobody's talking about the fact that gold's beaten the S&P 500 over whatever time period it is, right? Like,
some people like acknowledge that.
Yeah.
But you can't get away from it.
Yeah.
I can't ever remember someone asking Jay Powell in one of his press conferences after the FOMC, hey, Jay, you know, I know we're trying to solve this inflation thing here. You know, what about gold?
Yeah.
Okay? What about gold?
Yeah.
And there were a number of events in the market for anyone who's trading gold since the you know, October 23 launch of this gold market, you know, when they had the Gaza thing blow up. The Sunday night of December 4th, there was gold made a new high, and a lot of barriers and options were everybody knew about them, right? So everybody.
So these are options that are barrier options that are when they hit a certain spot, they kick in and they become profitable.
Struck it around 2175-ish or 21 somewhere up there.
Okay.
Anyway, so that Sunday night, everybody was on. Everybody was watching because it came in like 75 higher,
right?
And millions and millions of ounces were sold. And it went down. Not only did it go all the way down to unchanged, it went down 50 lower and closed 50 lower the next Monday.
Okay.
That Monday. I think 3 days later, 2 days later was a Fed meeting. And so I said to myself, no one in the world has either the desire or the resources or some kind of purposeful intent to sell that many millions of ounces of gold, but Janet Yellen.
He think it's Yellen. So are you in the Elon Musk, Donald Trump camp that there's not going to be the gold in Fort Knox that everyone expects?
I think there's something rotten in Denmark. I don't know what it is, but there's just
how about the fact that it's now $3,000? But now it's $3,000.
So you asked why I think it is, and we're sort of like slowly meandering towards why I think it is. What I just told you is that there is definitely an aversion to having gold be a part of the financial conversation now because we owe $36 or $7 trillion. Let's back up for a second here. You're saying gold is going up, really? That gold is not going up. Gold is like the sun in a solar system of financial assets that are all revolving around it. Gold is like the ferryman in Siddhartha. The river never moves. When I saw the sun coming up this morning, I think, it's the sunrise, but actually in my mind, I'm thinking I am rolling towards the sun on my planet, right?
Okay.
And so when you see gold go above 3,000, what you should really be thinking is everything else is going down like this, right? So, and that was the probe today. All of the paper world is in a constant trend lower because it can't escape the kind of doom loop that we're in, right? Which is with the market, the gold market I used to have a saying in gold knows, 2 words, gold knows what's going on. So, it is a constant commentary that Powell and no one else could ever get away from. And it would be the worst. That would be your career-ending question if you were at the press conference. So
that's funny. By the way, I take it you're a fan of JP Morgan's line, gold is money, everything else is credit.
I've heard it. I couldn't disagree with that. Yeah. I've written extensively long, collegiate pieces about the history of gold in Mesopotamia and the Bank of England in the 17th century and the founding of gold as money and, the major Roman mines in Spain. One of the great things about being in gold and having a life in gold is I know these things, and all of my friends and so forth, close buddies that I've had all my life, we all know these things. It's a kind of like we have our own language, and so everybody trades it differently. But knowing about, that gold coin you have, if you have any, that was probably mined in Spain in 200 BC or in Germany in the 15th century. There are only a handful of great mines that have ever produced the millions and millions of ounces. The South African mines in the late 19th century are among those, So knowing, when you start talking about Fort Knox and that gold, where all that gold is, most of that gold has been above ground, passed around in one form or another for centuries.
Do you think we're going to have an accident because of the fact that we have all these financial derivatives based upon gold, and theoretically, like going back to silver, and where if everyone asked for the silver, it caused the squeeze. Like, could you see something like that happening in gold?
Okay. So this, you're never going to get the answer you want out of me. I'll say that.
Why, you're just too scared of saying yes? Because I've been on record. I think we're going to have $1,000 up week in gold, and I know that's not
that easily.
Yeah, and I just think, to me, it's all about the People's Bank of China. I think they're the ones buying it, and they're accumulating it. And the reality is, you go talk to gold traders, guys that I talk to, and I'll say, do you know when they're buying? And they're like, no, we don't know when they're buying, but we know when Chinese banks come in and then they demand physical gold and they take it away and they put it on a plane and take it away. And like, that's the People's Bank of China buying it. And the reality is, to your point about all these financial, our state of affairs, if you're People's Bank of China and you have all these treasuries, why wouldn't you be, diversifying away from the treasuries into gold? It makes complete sense. And it's such a tiny market.
It's not that tiny.
But it's tiny compared to treasuries.
I would put it a different way. I think its market cap right now is around 20 trillion of all the known stock of gold above the world, right?
Okay.
But most of it, is diffuse. It's a lot of it's in the form of jewelry, which is in countries like India and other countries that don't have sophisticated financial products to do savings and investment. That's the way that they have their wealth. And there's a lot of it is in the motherboard of this computer or your cell phone. So
right.
It has industrial uses. And then there is the remainder of what was once official gold when it was, used for money, which is hoarded. We have 250 million ounces. I think among the European central banks, there's about 250 million. China's official statement of what the gold it has is absurd. They've been importing 1,000 tons a year, every year, probably going back to 2013. So
yeah, why would they tell us? Like I don't understand everyone that sits around thinking that these numbers are real. I'm like, why would they tell you that they're accumulating gold?
They have no, there's no upside for them to tell anybody,
right,
the truth about anything, right?
Yeah.
And it's like an Iowa corn farmer. Why should he tell you he's having a bumper crop, right? As far as he's concerned, that's terrible. Yeah, it's the worst crop I ever had. That's just human nature. Anyway, let's just put it in these terms. We have 250 million ounces or so. We're, reputedly 250 million ounces. If anything ever happened to that gold, it would be catastrophic to this nation. It would be irreplaceable. We would never, and I mean never, capital never, be able to replace it. It would be, and the loss of it, the intuitive confidence that all Americans have while all this shit's going on and everybody's lying and stealing and all this debt and everything else that's going on, we still have, it's like you or me or something like that. I have my gold coins in my sock drawer. I still know I have that. To have that be gone by any device, grifting or lies or something like that.
What about this? What about if Besant decides that they have to give to the oligarchs, they need to buy some Bitcoin reserve? And I know they've said that they're not going to add to it, but let's just imagine they did it. Let's just play a little game. Let's say that they say, we're going to revalue gold to 2,500 or $3,000 or whatever it is.
Yeah.
And by the way, we're going to sell a bunch and we're going to buy Bitcoin with it. Do you think that would be a huge problem with, like, would U.S. financial markets go offered in size if that happened?
Well, I don't know what this Bitcoin reserve idea is. First of all,
but let's just imagine they sold gold to buy Bitcoin. You just told me how important it is to the confidence of America. Do you think that the dollar would immediately react by going down if that happened?
I have no idea. I don't have a strong view on that.
Okay.
I'm not a fan of Bitcoin. John Paulson once said, Bitcoin is a limited supply of nothing. I, I, I thought, man, just sign me up for that,
That is
I
a
mean,
great line.
I can do anything with gold. You know, when the shit is the fan, if I have gold,
Yeah.
that's
Mhm.
the only next best thing would be food or guns, right? I can get on any plane, I can transact any transaction. You know, I'm the guy with gold. I can get out of town. So if I had Bitcoin, what am I going to do with that?
Yeah.
I can't do, I can't do anything. Plus, what happens if the power goes out? Where's your Bitcoin?
Well, this is my point, is that when you own physical gold, it is nobody's liability. There is nobody else that you need to rely on to own your physical gold. When you own a Bitcoin, you have a liability. The liability is to the network. That network has to keep going. And everyone thinks that the internet is something that's just forever going to be going and there's no way it could ever stop. And I'm like, no. And not only that, like, let's imagine we go to war with China. We all of a sudden cut the line between us and China. What happens to your Bitcoin? There's two forks. Which one is which? I have stuff here or there. Gold, nobody's taking your gold. You own it. We go to war with China, you still own your gold.
Right.
And that's ultimately what I concluded about
You
why.
buy gas, you can buy coffee.
Yeah.
You can,
Anyways, that's to me the argument. But anyways, that is a great line. Okay, let's talk about your other markets. You have any other views in terms of stuff that you like, don't like, love to share with us?
Well, I've been selling rallies in crude.
Oh, okay. Let's talk about that. Why? Like, because I look at this and for the first time, I'm getting kind of bullish. Like, I looked at the other day, Goldman Sachs had a series of sentiment indicators from all their clients, and they went through it all, and you could very easily see like the Trump bump, and you could see all these different things. And one of the things that I saw was just an abject bearishness in terms of crude. It felt to me like there's nobody left to be bullish on this. Nobody likes it. Am I wrong? Am I just early, or is it headed a lot lower? I'd love to hear your thoughts.
Well, the market acts badly. The margins are terrible. If you're a refinery, you're not really making much money, and you're doing an awful lot of work to make nothing.
Yeah.
We've got an ample supply of crude. Canada's going to continue to raise their production. I think we have had room to produce a little more crude, but the big risk to crude is LNG, and I think Trump gets that. He's saying drill, baby, drill. Well, I wrote a piece the other day called "Chill, Baby, Chill," which is, LNG, man. We have the biggest, most sophisticated, best capitalized energy industry in the world, and all we have to do is deregulate it.
Yeah. Okay. So do you like that gas down here?
I think nat gas is, I bought Natty when it was, in the low threes, and I traded it. I made some money. I got out, and then.
How do you, by the way, when you say a buy, do you just pick a month? Do you trade the strip? What do you do?
Well, it depends on what time of year you're in.
Right.
So the places just, I am an old timer with this kind of stuff, so I know what March, April can do. And everybody hated March, April. March, April was the worst spread on the board.
Right.
So I bought it.
Okay. So for those who don't know, March, April is a notoriously crazy spread because if it gets that one last bit of cold, I guess.
Either that or it's the one that everybody sells now, right?
Right.
I figured if everybody's this bearish on that, and natural gas had this winter the record high open interest, and it was very, very cheap. And I knew Trump was coming in, and I knew what I would do if I were going to try to build a manufacturing economy. I'm going to need a lot of energy, right? And that's not crude oil. You don't run factories and refineries and things like that on crude. You run trucks, cars. It's a transportation fuel. The energy fuel to fuel this economy that Trump is talking about is natural gas.
Meaning that it turns into electricity?
Well, electricity or furnaces and all kinds of other junk,
Yeah.
At any rate, and like in Japan, I wrote about this the other day. Japan their taxis have been running on propane since 1965. It's a very mature technology to run transportation. So it's cheap. We can do this for a century and never have to worry about a cartel or someone jacking us, or shooting our ships and so forth.
So you have a big picture view that nat gas is going to win over crude because it's a homemade.
We're going to keep doing crude.
I know, but in terms of we're going to move more towards nat gas, therefore is a better trade from the long side.
Yeah. Well, at both. I think this is what I think is why am I selling crude? Now, why am I negative on crude, positive on nat gas? Well, the energy equivalent factor of this guy Doomberg, who's really a great guy, really smart guy, is all over this. The energy equivalent is way out of whack.
Yeah, it's 7-1, isn't it? Or something like that, right?
It should be like 6 or 7-1. I mean, I don't know what it is now. It's like $5 and crude 70. So do the math. It's like double what it should be.
Right.
So having traded these markets all my life, I know that they diverge, they revert, and then the gravity of that relationship is going to bring those two together. And I see the fundamental future validating that thesis. So who wins? Do I want to be constantly dealing with nat gas? No, it's not like a primary market of mine. So I just bought a bunch of LNG stocks. And
okay.
And I've traded them all. So I know what I'm doing there. I don't really have to scratch my head and say, what am I going to get or anything like that. I just bought a few of them that I know well enough to own with confidence. And I'm just going to do that. Right.
Got it. Okay.
So let's go.
Right. Let's talk about some other things that you might like or don't like. What about, do you trade bonds? Do you trade dollars? Do you trade any of those?
Very rarely.
Oh yeah. You're a commodity guy more?
I get the same trade in gold.
Okay, so you'll focus on the gold and won't bother in the same with the
I'll
dollar.
look at those things, like every now and then I'll buy TLT.
Okay.
And it's an ETF, it's 20-year bond.
Yeah.
Right? So it gives me a little exposure to rates. It's not really something I want to do.
It's you can take the NYMEX trader off the NYMEX, but you can't trade. He's always going to be a NYMEX trader. Those are what the Chicago guys trade. I don't trade those, but you do trade a lot of SPOs. Okay. All right. I'm going to ask you, I'm going to leave with one question here because you've been very generous with your time. And I'm going to kind of spring this on you. I didn't tell you, but one of my favorite questions I like to ask people is, can you name something that someone did along your career that was especially kind?
Oh yeah.
Something that really stuck out to you, something in your career that someone did for you. And obviously you've already told the story of everyone coming around and funding your account by, doing a trade. I buy from you at, I sell you at 5, I buy from you at 6 and funding it. That's one thing. But is there one person in particular or an incident? Can you think of something off the top of your head? Or am I put you in too much of a
whole crowd of people?
Okay. So pick one that you love the best, not the best. Pick one that you'd like to feel the most comfortable sharing.
So I think I wrote about this in one of my stories. I was in trouble. I think I talked about this with Maggie. Trading terribly, behind on my mortgage, huge Visa bills and so forth, and I just came to the end of my rope, and I bumped into an old pal, and it's just before Christmas, rainy night, coming out of the exchange, and he said, "How you doing?" And I just, like a dam burst. I said, I don't know what I'm going to do. I'm screwed, So he said, "Well, give me a call tomorrow. Maybe I can help you with something." So, and it's not like we were bros or anything like that. He was a customer. He respected me. And so the next day he gave me just a huge amount of brokerage, kept giving it to me for a couple of weeks, maybe 3-4 weeks.
Yeah.
And it changed my profile on the exchange to where because no one wants to know you when you're losing.
Right.
And it helped me get myself out of the ditch, not all the way, but certainly helped me pay some bills and breathe a little bit. And it made it possible for me to get a job with a good firm.
Wow.
And I don't think I haven't talked to him in years, but it was life-changing.
Do you think he knows that?
Yeah, I think so.
Oh,
Not that it's not the kind of thing, that we had. It's just, I made it clear to him, hey man, this is great. I really appreciate this business. Thank you. It would have probably been a negative if I made a big deal out of it. Right.
Right.
You need your distance in situations like that.
But he just knew that it was the right time to help you out.
Just did what he did, and I needed it to be done, and that's the way that went.
Well, that's great. Okay, so let's talk a little bit about your Substack. It's called Market Vibes.
Yeah.
And if we just Google Market Vibes, let me just see what happens. Are you the first to come up? You are. There we are.
Well,
Market Vibes, Alyosha, on Substack. You write twice a day. You are very diligent, very disciplined, I must say. How do you find time?
Well, the nice thing about writing, particularly to a community of people who are at a very high level, they are quick to say, you got that wrong, or I disagree,
right,
or I challenge that.
Yeah.
That no disrespect,
No, yeah. They're just people telling their opinions.
Really great community of people who are curious, skilled, experienced, and always looking for an edge.
Right.
So it's demanding for me. I have to know what I'm saying. I can't be careless. I can't be tired. And I have to be on top of it at a level where, it's not only fresh and energetic, but I'm also providing a kind of a concierge service that, if you don't have time to do other things, you're busy or something like that, you may have missed the fact that, open interest fell off 6% yesterday.
Right.
Right. But I'm going to point that out. Right. And if another market is moving, it's correlated, or if it's negative, if this is wrong, or that's wrong, I'm going to point that out because I'm going to probably be trading it.
Right.
I'm going to have money on it. Right. and that's 95% of why I've always been a broker who writes.
Well, that's awesome.
Because it forces me to know what I'm thinking.
If you want to know a subject well, you should write about it. JJ, it's been a real pleasure having you on. I really appreciate it. Check it out. Market Vibes on Substack. Thanks a lot for your time.
Thank you, Kevin. It's been a pleasure.
All right, Patrick, it's time for talking charts. Lots to talk about.
Oh, yeah, for sure. Okay, let's quickly punch through the top 3 things to watch. I want to spend a lot of time during that to actually talk about them technically on the charts. But first thing I think is important to watch is whether this gold breakout was a breakout or a fake out. The infamous prairie dog or not. All I know is that actually things are behaving very well. I was at first a little cautious because things were advancing pretty quietly, but the silver market has woken up. All of the miners are participating. And more importantly, Kev, it's happening at a time when there's not a liquidity event, but liquidity is being sucked out of the stock markets. And usually that causes pressure on almost all risk assets. And the fact that gold is behaving very well and all of the gold miners, everything, I think that's definitely a positive. What's your take?
I think it's one of these cases where it's one of the quietest bull markets that nobody cares about. And the more that this goes on, the more excited I am. I am a little concerned that you do see some big upticks in terms of the amount of GLDs getting created. Like there was a lot of financial North American financial buying. Yeah. But having said that, that's what you see at the start of bull markets often. And I still contend, Patrick, one of these weeks, we're going to have $1,000 up week.
No, there you go. Please, I'll buy you a very nice bottle if it happens. All
I'm
right.
going to hold you
So
to that.
number two is this the beginning of a bear market, or has this just been one big market correction? And I think this is a conversation I actually want to spend at least 10 minutes on the charts in a moment. But let's at a higher level talk about this. First, what are your thoughts? I mean, you've been pretty bearish, but you think that this thing is far from over, or is this
Yeah,
already getting?
this is the start of a bear market. And now the thing about bear markets that you need to remember is that there's massive corrections in it. Go back and look
Yeah,
at the
that's what I want to look at.
2000.com bust and how many rallies there were. And actually, for those that are interested, go to my website because I actually reprinted that, or send me an email, kevin@themacrotourist.com, and I'll send you a piece because I actually reprinted a post from a couple of years ago that I showed. I think it was right at the start of the 2022 bear market where I just highlighted the fact that there's in bear markets, you get these violent
Yeah.
1-2 day up days. And I think there was 7 that were kind of like more than 7% in the
Oh,
dot-com
absolutely.
bubble. It was monstrous. So
Let's
when
let's
it,
let's look at that technically. I
okay,
want to definitely talk about that. The third thing to watch for everyone to watch is the FOMC. And it's not just the FOMC. We have Bank of Japan and I think the Bank of England all within 24 hours of each other in there. So a lot of monetary things coming. But the thing is clearly the market is reacting far more to politics and administration than it is about Powell. Will Powell try to take that stage back? Like, is he going to make monetary policy matter again? What's your take?
that's good. I like that line. No, so I contend that monetary policy matters a lot less than people expect, and that it is actually you should be focusing on the fiscal. All you have to do is look at what's happened in Europe, and you can see that the huge rally over there was a result of Germany finally,
Yeah.
abandoning their debt brake. And in terms of monetary policy mattering and make it matter again, I don't think it will.
Okay, so let's dive into the charts here, Kev. Or let's start with the S&P 500. I want to talk to your point. So I'm going to put this on a weekly chart just so that we can really go back. And I want to go back and observe both the bear markets of the past, which is let's starting with the 2000.com bubble. And what I want to highlight is how did the 2000.com bubble start? Well, it started with what was basically just over a half a year topping formation of where the S&P more or less failed to make higher highs. This was, though, accompanied by the Nasdaq ripping to 5,000. It was like a parabolic blow off, but the S&P didn't participate in the final takes. And in many ways, we had our own version of this, which is the breadth of the market wasn't there. Most of the market wasn't participating, and the Mag Sevens took off and where all the performance was. So even though it didn't necessarily reflect in the exact way it happened back then, you can see an echo of the way that that transpired. But after retesting its highs, the initial drop in the market was about 42 days long and about 15%. Right?
Right.
We're 10% into a 30-day correction. Not even. We're like 20 some odd days into this correction. And so we're in a situation where even this very first leg of the bear market, which just started to violate that 50-week moving average, which is almost like a 200-day moving average on the weekly charts, and yet that was just the beginning of the bear market back then. But to talk about the violent bear market rallies, as much as on this chart, this doesn't look like a lot in terms of the bounce. That initial bounce off of the low from trough to peak was a 10% bounce in the
Yeah.
markets
You just like you
in
look at
previous.
this, Patrick, you look at the chart and you think, oh, it's so easy. I'll just get short and I'll just ride it all the way down. And then you realize like within there was some face ripping rallies that
Face
would have
ripping
been
rallies.
really, really difficult to stay short. And that's
Right.
ultimately what everyone needs to remember is that bear markets are tough to trade.
No. And so but what I want to highlight is this if this is a bear market, then we should see something like this. I'll explain when we look at the some other versions of this, but you basically have it trading below the 50-week moving average temporarily, and then it bounces, and there's a short squeeze bounce, but it's short-lived. It's just an incredibly oversold market that does a reaction and a reflexive rally that is just a bear market squeeze to the upside, and then the bear market resumes. So go back. Let's go to then how the bear market started during the financial crisis.
Actually,
So,
before you do, Patrick, can I just tell one quick story?
yeah.
As you're saying this, it reminded me of this book that I read about the 1987 crash. And during the 1987 crash, there was lots of people that were worried about the stock market being overvalued. It was very frothy. Yeah. And on that Friday, we had the initial kind of first sell-off in the 1987 crash, and it was actually pretty large. And there was I've read stories and recounts about people having parties that the correction was over, that finally we got the break, and finally we got the correction that was here. And yet that was just actually the start of the bigger and uglier point.
So let's actually take a deep dive into this thing. So the first in 1987, the first decline was about 9% in about a month. Right. And then the violent short squeeze that lasted just about a week or two was a 7% market bounce that happened in a span of a week or two, violently ripping to the upside before the crash sequence. The reason I don't like the 1987 analog for situation we're in, though, is because I wouldn't call 1987 a bear market. It was a crash. But it wasn't a prolonged period that was accompanied by huge recessions and some bigger cycle. And I think that's an important thing to take away is if we're just going to get a little crash, then you can't use these bear market. Just a little crash.
Just a little crash. 1987. Just a little crash. Yeah.
But if we're gonna,
if you held on, you're good. You're good.
You're good. But hey, buy and hold worked both during COVID crash and in 1987 crash.
Yeah,
they did, right?
But during no moments of doubt there. You could have just held on.
There might have been just a few moments of doubt. There might have been just a few. Okay, so back to 2008, and after double topping. There was a quick market drop that dropped below that 50-week moving average. That was about 11% drop in the market that lasted about, let's say, 49 days. So let's say a month and a half, right? And even then, it had a bounce that was 8% in less than 2 weeks, right? Again, another violent thing. And then came another leg down that was like this 2 to 3 month 20% decline, 18%. Point though is that again, of something that was like a 10+% market correction, a violent 7-8% rally, and then rolls over. So then let's take 2022, which was really more of a bond bear market than a stock bear market. But even then, the first wave down off of the high was about a 15% decline in the market over close to 2 months. And then that initial rally was a 12% rip to the upside off the thing. This is where I'm just confirming what you're talking about, which is
just imagine, put yourself in that place. Don't think that everyone wasn't getting bullish again. They were. Yeah. Everyone was convinced, oh, there we go. The correction is over. We got the rally. Time to get excited.
Yeah.
And I think this is the point where actually your technical skills really help, because that is the kind of the reaction after that reaction is what's going to really set the tone.
And a failed rally is I would argue that while trying to catch the top of the market is like something you could put on your belt, like a trophy type of thing, like it's a thing. But the real shorting opportunity is the first failed rally, because it's the first failed rally that you know that the tide has shifted, that the Bulls are no longer in possession of the ball making a drive, but it's the Bears that are in control. It's then when you can, with more confidence, lean into shorts. The only big advantage of hitting the exact top is usually you got much cheaper volatility premiums on options. So like positioning yourself short usually can give you a better asymmetry just because you're getting cheaper options. But the point being here is that we're now just at this current moment, we had a peak to trough 10+% correction that lasted 20 days. And so we are, even in comparison to all of the other breakdowns, this is actually so far the most mild one on a S&P basis, because I know the Mag 7s were much deeper and things like this, but on the S&P basis, this is a relatively mild one. So at any one moment when a short squeeze happens, let's say the an 8% bounce would be 5,900. And a 10% bounce would be almost retesting the highs at 6,000.
Right.
And so like just the idea that if this market went from 5,600 to 5,900, it would be very hard, A, to hold on to your shorts, and two, very hard not to want to get bullish, thinking that this was that big buying opportunity, and the bus has left the station and I'm not on the bus. And you know, that kind of FOMO kicks in every time, right? And so this is a really interesting moment. I think, to me, even if we temporarily beat 5,900, to me, it's about whether the market primarily trades below 5,900. So if it spends 2-3 days above 5,900 and then comes back down, to me, that's not breaking the rule. It's about the idea that it's not going back to the highs. It's not resuming a bull trend, that this was just simply a reflexive snapback rally. That's this violent bounce. And then if that rolls over, then the market's fucked.
There we go with all that technical jargon again.
All the jargon, it's fine. Anyway, so but yeah, we're at a really interesting moment. Is it going to be you know, the one thing I want to immediately jump to is me and you talked about in previous episodes about a canary in the coal mine. Do you remember what it was? It was the junk bond markets.
Oh yeah, okay.
Yeah, right. And we talked about the fact, and you were the one that highlighted this point, which is you said that there are plenty of times when the markets have a 5 or 10% correction and the credit markets don't care.
Right.
But
and that's actually
rarely,
the signal. That's actually the signal that there's going to only be a 10 instead of a 20.
Right. But almost every, 15 to 25% market correction has credit markets reacting.
Correct.
And or leading. And so we have, this is from Koifin here, our good friend Rob over there who has a great site. We saw the credit spreads widen from like 260 up to 320. Right. And so definitely a widening, and this is on the broad base, but and very distinct breakdown in junk bonds. And I would argue the canary in the coal mine is officially dead. Technically, it's dead. I mean,
I'm not as ready as you are to call that. To me, when you actually look, I saw a chart the other day from Goldman that showed the relationship between, I don't know if they use CDX or the iBox, but they were comparing credit spreads to the stock market. And the stock market correction was definitely a lot more than the credit spreads. And the trouble is the credit was so tight that you knew that it was going to back up. But when you kind of take a bigger picture and step back, like I'm just pulling up the 5-year IG credit, the CDX right now. Yeah. Okay. So it moved from 46 to 55. But the reality is that, we spent all of 2022 with it in around 100. And this is actually still a really tight credit situation. So I'm not as willing, no doubt the canary is slowing down. The canary is slowing down. You think that because that, it hasn't moved in a little bit, that it's for sure dead. I'm saying I'm watching that canary because I'm worried.
It's on the ground twitching.
No, like it's not about to die. It's just kind of kept quiet for a little bit.
It's kind of like just like it's like dozing off, like it's about to go to sleep, but you don't know if it's Okay.
So here's the real problem, though, I think, with credit. And I wrote about this because I think this is a really important part of the equation that a lot of people are missing. With the popularity of private credit, which has just exploded in terms of its people chasing that asset class, a lot of the really crappy credit, meaning the junky kind of more risky credit, is not getting put in the indexes themselves. And when you go and you talk to really smart folks that are into this, they'll say, the quality of the indexes are much better than they have been in the past. And so one of my worries is we're sitting around watching corporate credit or even trying to get short corporate credit spreads. But the reality is that the real problem loans, the ones that are going to hurt you, are actually sitting in private credit world. Yeah. And so on that basis, I might agree with you that maybe the credit situation is much worse than it looks like by watching just the OAS on those indexes, because the real pain is occurring in unmarked books that we're not seeing.
I love it. You know what? That's wisdom, buddy. I hope all the listeners should have a listen.
All right, what else you got?
For me, we got the canary's dead. All right,
okay, I know you think the canary's dead. I'm worried about the canary. I'm thinking about, even after I'm saying this, I am short the private equity firms. I do think that is what's going to end up being the blowing up portion of it. Having said that,
they already got hammered. This is like look at Blackstone. Off of its peak to trough is already 33% off of its high.
You would have been proud of me when I read that. Did you read my piece? I had like a sophisticated option strategy with different parts and stuff.
What?
Yeah, you should go back.
Oh my God, I'm going to go back and read it now.
Yeah.
That's awesome.
I had various parts.
You have tranches of options.
No, I was selling credit spreads to buy puts, and I was doing all sorts of stupid things. But yeah, you
all right. Well, I love it.
You're rubbing off on me.
All right, I love it. Okay, so one thing I wanted to talk about now is volatility, and what's interesting to me is not that we got up to 28, but we got up to 28 on the VIX methodically. Now, you take the two little scares we had in 2024 with the yen carry trade unwind and that little December spike. Each time it was almost like a 1 or 2 day, everyone puked in a bucket. Someone hit the panic button. Things got out of hand, and vol mean reverted very, very quickly within days. Right. And that is typical of corrections within a bull market. But when you look at, for instance, what volatility did during 2022, I remember when we were doing the show, and I kept asking you, are we ever going to see under 20 again on the VIX? For you remember those conversations we had? It was a period of sustained higher volatility premium.
By the way, what was my answer?
You were saying yes.
I find myself in this weird position, Patrick, right now.
Where you always want to be short vol.
Well, no, where I'm actually lying ever since basically Trump. And I realized that, in my opinion, he was going to make macro great again. And I thought that the world was underappreciating how much it was about to change. I've been nothing but long volatility on all sorts of things. I love it. And I feel weird. I just feel weird. Eh? And you know what's amazing, Patrick?
Tell me you're doing a little bit of offsetting selling so that you're trying to kill some of that data burn carry.
Of course, you know me. Okay. But having said that, I find it strangely off-putting for the S&P to be, going up and down these huge amounts, and for me not to be offside. I'm not losing money on these gyration moves. Hey, there's something to be said about being long volatility. Anyway, sorry, I
So,
interrupted. I think
no,
that
no,
is a
no.
great
So,
point, though, Patrick, that
yeah.
that it on prolonged bear markets that we don't get the spike. And so are you arguing the fact that we haven't got the spike?
I don't know about arguing. I'm asking because it's so weird to me that during this whole sell-off, it was an incredibly methodical climb higher in volatility. And to me, one of the clues is going to be, do we see sustained higher vol on a day in, day out basis for the weeks to come? Are we going to generally see a new higher range for volatility premium? Because if that's there, to me, that's another clue that we've transitioned from a bull market to a bear market. And I think that dealers are just going to command more vol premiums to hedge themselves out, and it's just going to be a new higher volatility regime for that kind of perspective. That's you can comment.
Well,
you think it,
the only thing that I'd like to comment is I'm a big fan of Dean Kernat and his Alpha Exchange, and he loves talking about volatility, and his insights are wonderful. And I think he's the one that says it's really the second move that gets you, because the first move, usually what happens is that clients are well positioned. They bought protection. But it's the second move when protection has become too expensive and people say, "Oh, I don't want to buy
that."
Yeah.
I never thought of that, but that's true because rarely do hedgers go out and hedge 6 months or a year out.
Yeah.
Some do, but
I
that's
did.
not what
No, you're right.
majority of people
Most
do.
3 months.
Even
Like
if you're lucky, 3 months. Some
Yeah.
fucking use zero DTEs. Look at me dropping bombs here, but like I'll wash my mouth with soap here. But like they use zero DTEs. They're hedging out with very quick little options, trying to make quick moves, and inevitably. The volatility spikes, the cost of the hedges destroy the asymmetry of doing it, and suddenly they're bag holders.
Yeah.
And then they have to choose to just unwind their positions, right?
Yeah. Speaking of zero DTEs, have you been following Brent Kuchubo and his spot gamma with his Captain Condor?
No.
Okay, so Captain Condor is this lunatic that does iron condors in zero DTEs. And when he loses, he just doubles the amount of contracts he does.
He's martingaling it.
Yeah, he's martingaling. And so it's, oh man, I was having so much fun in my chat. We were all watching it and seeing if Captain Condor would blow up, because he was like, at one point, I think he was up to, was he past 22,000? He was doing 22,000 of the big S&Ps. Like just a massive position. He's just doing this, and he's just like, it was 5, and then it was 10, and whatever, and he keeps doing more and more and more. One of my buddies that follows it closely told me that he was up to 50 at one point. 50,000 contracts. Like, this is wild. So anyways, go tune in to Brent Kachuba and his Captain Condor. I made a little, it's in my chat. I made a little AI of Captain Condor.
That's hilarious.
Yeah, it's pretty funny because, martingaling, nothing ever goes wrong there.
Never.
No,
never. It's a winning strategy that you can repeat over and over again.
Ask optionseller.com. He knows.
Yeah. Oh yeah. No, that's, and especially do it on the Widowmaker.
That's right, on Nat Gas.
Okay. Actually, you know what, Kev, this is a great opportunity, because I wanted to switch to the dollar, but like when we're on stocks, this is an opportunity for me to just have a quick conversation. I'm doing that special webinar on how to repair stock positions using option strategies. I'm going to do a shameless plug. You can just go to bigpicturetrade.com and register. We're doing it on Tuesday, the 18th. But the idea behind it is that while there are these violent drops in the market, there are also going to be violent rallies. And I'm going to use Tesla as an example. But let's say somebody bought Tesla thinking it was a bottom at $300 a week or two ago. And they find themselves suddenly, the stock goes and drops a further $80 to the downside in a span of a week, right? And you find yourself offside. Well, the thing is that how can you repair the trade to try to improve the level from which you can get out of this trade at a lower price point, a lower break even to get out of the trade? And like one of the popular ways of executing that is, let's say, for instance, doing a ratio call spread. And as an example, let's say right now Tesla's at 250. I was just looking at the live market price. If you, let's say, went and bought another call option at 250, right at the money, it was somewhere near $20, and the 275s were all trading for about $10. But you would sell twice as many of the short calls above, because your original stock is covering the one call, and the second call is like a debit spread covering the credit from the other. So you basically, it cost you nothing to open the ratio spread. It was $20 in, $20 out to open it. But if you originally purchased Tesla at 300, your break even on the exit is at 275. You literally have allowed yourself that, I'm going to put on like an hourly chart. If you just simply had Tesla make one quick little pop up here to 275, you could near expiration get out of this trade at even. Right. And the point being is that you didn't need the stock to rally to $300 and to get back out at your break-even price. And so there's these option strategies that are really important. And why is this something I highly endorse? Well, what's the most common way most people repair trades? Dollar cost average. Right. The problem is that if you go and double the amount of money that you put into Tesla, let's say you had 1,000 shares and you go buy a second 1,000.
Oh, I like it. Your clients are obviously shooters.
Yeah, but let's say you had 1,000, you go and slam in with another 1,000.
Yep.
Now, if this thing was just a flagging formation, it drops to 200 or 180, you're losing now at twice the pace, and the pain is becoming twice as hard. And you took really good, nice, clean money and you threw it after a bad trade and making the whole thing a big hot mess, right? But with this spread strategy, if Tesla keeps going down, well, the call options, you paid nothing for them and they just expire off there, and you're just stuck with your original shares. You didn't double down. You didn't increase your risk to the downside. And so it's one of the tools in your toolbox that you should know how to fix things. And, very few people understand it. I'm going to just do a great webinar explaining it in greater detail. And anyone who wants to join is completely free. All
Got
right.
it.
That's
bigpicture.com Tuesday, but you have to sign up ahead of time. You can't just show up.
Bigpicturetrading.com. You see, you got to give the right URL. You said bigpicture.com.
Oh, sorry. Bigpicturetrading.com. What is bigpicture.com? Let's go have a look.
Oh, don't.
1 second. I gotta see what it is.
Subliminally sending the wrong message to
I know.
people.
I'm sorry. I am terrible. Bigpicturetrading.com. Trading. Don't ever forget the trading part. Otherwise, you're going to end up at some weird venue or something. I don't know what's going on here. Right. It's a concert. Okay. Sorry about that, Patrick. Right. I completely...
It's not worth mentioning. We're all waiting in suspense here.
I don't know. It's some sort of concert venue or something. I'm not really sure what it is.
Okay. So let's talk currencies.
Okay.
And the currency whisperer got me.
He's awesome.
He got me.
He is so good, is he not?
He met me in the machine and he
just took it all. He saw your offering in your own. He's like, bought from you. I'm bid. Where do you offer me the next piece?
God,
good for him, man.
All right.
Well done. I love the currency. And you know what the nice thing about the currency whisperer?
He's a nice guy.
He's a beyond nice guy. He's truly one of the best guys out there. So,
he'd give me my money back if he was truly a nice guy.
Listen, if you're ever in New York City and you want to meet the currency whisperer, I'm sure he'll buy you a bagel or something. He'll do something.
Oh, really? A bagel?
Not
even a beer.
He'll take you up for a beer for sure.
All right, there you go. All right. So anyway, the part about the dollar was not the breakdown. The breakdowns happen. Trump says something, spooks the markets. The dollar makes a bad break. But what is really interesting to me is we haven't seen any violent short covering squeeze rally the other way, which is very typical if it was a buy on dip. And this is where I have to take the knee and admit that the cautious bullishness of this being just a correction has big holes in it, and I have to accept that something different might be happening here. Because if it was a short-term little drop, we should have seen it back to 105.50, 106, 107 already. And
Right.
instead, the selling is just there. But the part that I'm curious about the dollar index is that it doesn't feel like this is a broad, US dollar sell off and all other currencies rising. This has really been a euro and a pound, so European area currency move. And because like so the euro was where literally the major snap happened. Pound sterling joined the party, of course, with a little continuation. But beyond that, even though you have been right about the yen for quite a while, the thing is that in the last week, it didn't really do anything. It
Yeah.
wasn't where the move was. The Canadian dollar has not moved much. The Australian dollar hasn't moved much. This really was a reaction to Europe.
Yep.
And I
Completely
think the
agree.
European used it. But the thing is, and in my mind, a true US dollar bear market should be the US dollar declining against all of the cross currencies. It should be a complete repricing of the dollar against it. And so far, this has just been an incredibly oversold euro that was given a catalyst for a very big snapback. And for me to get outright bearish the US dollar, I'd want to see all of the currencies starting to confirm that something has changed. And it's just not there yet on all of the cross currencies. So I think you have to play it. Maybe it has to be just focused on the individual pairings. You focus just on the euro USD. You don't just play where the action is and the catalyst is and the story is, and focus on there. But I don't know if I want to make it a broad US dollar call, rather a much more a US dollar against that euro.
Okay. I'm going to agree with there, but I will say this. I think that that's just the first part of this leg.
Oh,
And then the next leg, maybe the yen goes bid again. Maybe the renminbi goes bid. Maybe even Canada goes bid. Or Australia. I really think that although I can't dispute your analysis so far, that this is just early stages of a
so
monster US dollar bear market.
okay. Well, bull market or bear market, the one thing I do want to highlight. So I just here have the monthly charts on the US dollar going back to 1981. All right. So like I want to really zoom out. And I want to highlight that the last half of a decade, this was the range that the dollar has traded. And when you put it in the context of the kind of volatility that we have, currency volatility we have seen throughout the last 40 years, 40 plus years, uh, w- a big move in the currency is not out of line. It's actually far more often that these currencies are moving huge. And the fact that we've been in such a tight range is actually the rare event. Uh,
Patrick, I couldn't agree with you more. That's why I've expressed all of my currency views with 1 year options. I think vol in currencies is so friggin' cheap. Like it's just so
yeah.
cheap. And that is going to be, listen, how long before Trump's getting up and getting off the toilet and tweeting out the yen's too weak?
But I don't think that starts a dollar bear market. I think that there has to be a bigger catalyst.
Well,
You're talking about trades. Trump tweeting something is gonna and creating a 200 pip move is just a trade. To me, I'm talking about a meaningful dollar repricing,
because
and
I
it's
think it's going to be, Patrick, it's at the crux of the problems about the US losing all its manufacturing. So even though you're kind of saying,
yeah,
okay, he tweets
I get
it,
it.
it doesn't matter. But the reality is that the tweet will represent a battle that will be going on amongst
So
nations in terms of the thing. So it will be followed by policies and by disputes and by capital fleeing. And I think that we've just started to see this.
so what I can't wrap my head around here, Kevin, you can help me with this, right? Um, it's not about just a dollar going down, because it in turn means that other countries need to see their currencies rise. And even though you're going to see more fiscal spending in Europe and all of these other types of catalysts, I mean, can't like what would happen to the European economy with if the euro started a rip to the upside and to like let's just put up a chart on the
See,
euro.
I don't buy that argument. I
You
like
don't at all, right?
I hate that
Okay,
argument because like
so like
let's
let's
face
say it
it,
went back to
people could have said
150.
the same thing about the US. Like this is that you're basically making the same argument that the people that argued that interest rates were going to crush the economy in 2022. They said, "Oh, the interest rates are going to crush the U.S. economy," and there was lots of them. There was lots and lots of folks, and they persisted for 2023, 2024. And it really wasn't until the end of 2024, 2025 that they got bullish on the U.S.
Yeah.
economy. But all that time, they were like, "You interest rates are going to crush them. Interest rates are going to crush them." I don't buy that argument. People are underestimating the power of fiscal, and they're not realizing that all the lower rates and the lower currency hasn't helped. Like, let's just take Europe, for example. Europe had negative rates. Did that help their economy? No. Europe had a lower, currency. Did that get it going? No. What's going to get it going is actually confidence in the economy. And the confidence is going to come when the government isn't starving the economy of funds. And so I'm going to push back hard on that. And I know that, Patrick, your thinking
I'm just trying to reconcile it.
I know, but your thinking is going to be consensus. Like, so, and I realize I'm saying this and people are going to be like, "You're full of it, Muir. Like, you're absolutely wrong." But I think all you have to do is look at the actual empirical evidence of what happened with the US. They had the strongest economy in a period of rising rates, rising currency. They were the strongest in the world. So I just don't buy that. Anyways,
Okay.
that's my pushback. And I apologize to get feisty about it.
No. Listen, get feisty. I to me, I'm just having a hard time reconciling how that would all play out in terms of if the U.S. dollar weakens, and how does it play out for other countries? But I get your point.
And the other thing about it is that all of a sudden, all these other countries, their own economy is going to be doing better. Like, let's just take China. China is now forced to go from a policy of one where they were actively trying to stop speculation. They were trying to, weed out all the problems they had in real estate. They were purposely putting their brake on the economy. Now, all of a sudden, they're looking at it and they're saying, "Holy shit, we're getting tariffed by Trump. This is a disaster. We need to get our own economy going. We need to be our own consumer." Yeah. And so all of these things are going to mean that the world around the world is going to be spending more fiscally. So instead of relying on the US buying their stuff, they're going to buy their own stuff. And ultimately, that's why I think that it's bullish, all these other currencies. They've been sitting around trying to balance budgets, doing all these stupid things that just don't work. And now all of a sudden, and counting on the Americans to do it. And listen, I'm sympathetic to Trump when he says, "This is ridiculous. We're running a huge trade deficit. We're running a huge fiscal deficit. You guys should do some spending." And he's right. And now it's coming, and it's going to mean that these other currencies are going to go up and these other stock markets are going to go up.
Right. All right. I agree. All right. Okay. At least I appreciate what you're saying, and it makes sense. So let's move on to gold. Oh. And whenever I see a strong breakout on this, one part of me wants to completely jump on the bandwagon and just like, this is super bullish. The other part of me always sees a prairie dog, and because they're
the noble animal. It's a noble animal, of course.
And the thing is that I want to see a couple of days to just see whether or not we get some sort of a drop back into the trade range. The one thing, I've remained decisively bullish gold, never once deviated from that. My debate always was, is this the window of time when the next leg was going to happen? Or was it more of a second quarter story after a couple of months of consolidation? And what I mean by that is, like, if we look back, there was two periods of considerable consolidation after rallies. This one lasted 3 months right over here. This one lasted about 2-3 months as well. There's these periods where they just takes a break and trades sideways, right? And so what I was trying to figure out is whether or not this was one of these periods where gold was just going to take a break and then it still resume in its bull manner after consolidating. And so this resumption happened in less than a month
Yep.
after a swing high. And this is where I'm just trying to settle in as to, is it really just a bull continuation right here, right now? Because this measures up to 3,200 on the upside for this impulse. And there's still plenty of money to be made if this is a real breakout. And I think that the puzzle to solve in the next couple of trading sessions is whether this was a breakout or fake out. And while we were both in the camp that it's a breakout, you can't rule out the fake out, or unless this thing can hold the gains for a couple of days.
Okay.
And
sorry. Finish up, and then I want to chat about this.
no, I'm not. That's the point I was going to make.
So you know me, I have consistently talked about how the People's Bank of China is the underlying fundamental reason why you have to buy gold, because they have no choice. Yeah. They need to basically diversify their foreign exchange holdings into gold. Gold is such a tiny market. One of the things that I have also been, steadfast in terms of reiterating is that when everyone gets bullish, you need to be careful, because a lot of times China will just pull back on their buying. And when everyone gets bearish and all of a sudden, and that did happen, it was a month ago, it looked like it was rolling over. Lots of people got,
and they just stepped in.
And they just stepped in. And that's kind of my conclusion in terms of trading gold, is that it's going to trade weird, and that it's not going to be as clean as everyone thinks.
But listen, for weirdness, technically, it has done everything very technically clean. Pullbacks to moving averages, consolidations that are flags. I don't see behavior that is out of norm of what I would view as normal technical price behavior. And so other than it's a bull trend and being very well accumulated. So
but I would say this, Patrick, don't you think that the sentiment has been consistently to chase rallies and then to get bearish on the dips? And then maybe you're right that when you're looking at it from a technical perspective, it hasn't done anything that weird. But I would say that right now people are foaming at the mouth, and I could see everyone getting in there. And then all of a sudden it dips, and it dips back to the moving average, that place that you highlighted, and everyone's bearish then. And it's just, so maybe you're right. I mean, I don't know. I just think that you should be careful about getting too excited about it. Don't get too excited as it rallies and everyone else gets too excited, and don't get too pessimistic when everyone else gets too pessimistic.
I love it.
And then one last thing though, Patrick,
fade the sentiment.
I'll tell you this. Eventually it will become a North American long. I don't know if we're there, but there will reach a point when the People's Bank of China will be competing with financial flows from North America. Because let's face it, up until now, it has been a hated market. But that is changing, and there is some sentiment changing.
I'll tell you though, people can't overlook also that gold is priced in US dollars. It's priced in all sorts of currencies.
Right.
But a strong US dollar has generally made gold have a subdued move. If there is any meaningful US dollar bear market, that is when gold has done some of its most spectacular moves.
Right.
And so if your dollar thesis is right, then that in itself, it makes the gold story that much more exciting.
And what I'm watching for, Patrick, is the handoff from the People's Bank of China controlling that market to eventually North American or Western, let's call it, flows. Yeah. And if that ends up being the case, then all of a sudden all bets are off. That's probably when we get our $1,000 up week, like I've been predicting, because there won't be the same discipline in terms of pulling back when it works.
Yeah.
Like up until now, the major buyer has been very disciplined. And maybe that's why, from a technical perspective, it's worked so well. They've been very disciplined, but then it comes back to the moving average.
That's because there just isn't anyone they're competing with, and they can control that nice methodical flow.
Exactly.
When everyone else joins the party, they'll have no choice but to compete.
I don't know if they're going to bother to compete because they're just going to make it worse, but it won't matter because at that
what I mean by compete is that they'll be adding to the buying.
Right. It might just be that the Western demand takes off.
Yeah.
Because all of a sudden we'll go from Western,
so
counterparties usually trying to short gold to now being also buying it with
so
no offerings in sight.
So I didn't mean to cut you off.
No problem. Go ahead.
Oh, I was just going to say we have to talk about gold's little cousin, silver.
Okay.
And this is a weekly chart, and it never really gained any big traction in the last 6 months, stuck in that range. But here we are at a 52-week high, and things usually get attentions when they break to all-time new highs. So the big question here is this the moment where if gold broke out to a new high, that silver joins the party? And a breakout here could open that window for a move to like 36, 37, $38 on a very short-term basis. It'll be interesting whether this gets underway.
Is that a cup and handle? Am I doing that correct?
You could call that. I mean, yeah, you could call that a cup and handle. Sure. I'll give that one to you. Okay. But the other thing I wanted to highlight was the gold miners. Like in a period where it's very hard to find any equities that are doing well, the gold miners are doing well.
And they're cheap. They're cheap. They're going higher. Yeah. I keep saying it. It's going to be one of the best performing sectors out there.
The last thing, and then we'll wrap it up for the day. I wanted to just touch on bonds. We can't not talk about bonds, but they've been pulling back for the last week, and a little consolidation. But with your little smirky smile and everything, so far bonds have behaved exactly in line with what a bullish accumulation pattern should be. It rallied all the way to the December highs. It found some resistance. It's pulled back to the moving averages, right to a retracement zone. And this is an inflection point for where, if this is a bullish market, it shouldn't go any lower. If we see 116 hold here on the long bond, and it turns up from here, then some form of a bullish trend is forming, even if it is just an intermediate move. Remember, I'm not bullish like 2% yields are coming back, like long-term buy and hold. I was just saying that ridiculous sell-off that happened in 2024 made it very oversold, and a reaction the other way was coming. I would not be shocked if we went back to September highs, but on a weekly basis, that's not a stretch. It just coming back to the top end of this trade range that it's been established at its bottoms. I'm not looking for a huge bull market where we're going to see 150 or 160 on the upside. But I think there's room for this to still edge a little higher. But if it is going to go higher, literally, this is that moment. If it breaks down back to 114 or 113, it's not the kind of price action that would be typical of something that's being bulled and accumulated. And then I'd have to take a little more of a neutral stance on it.
Okay. Well, I'm firmly in the neutral camp.
I
think it goes nowhere.
Well,
I think 6 months from now we're talking about nothing's changed.
But Kev, when I put it on a weekly chart and I define this as its trade range, if bonds did this and this, would that not also be going nowhere?
Yeah, no, I hear what you're saying.
Yeah,
you're saying there's a tradable rally. Listen, you articulated it very well. I'm
just saying the trade range thesis could happen very well, but I just think that the trade range is a little bit wider than yours. You're much more sticky to the bottom end of the range, while I think there's room for it to go towards the top end of its weekly ranges on that front.
That's a great summary of the difference of our opinion.
All right. That's all I've got, bud. I think, well, that's we didn't let Danny talk at the beginning of the show.
We'll let him talk
we'll
at
have
the
to
end, but
bring in
let me
the
just sign
absolute
off. So listen,
sign off.
everyone, thank you for tuning in. Bear market, bull market. It's just a lot of fun. And I'm going to give a special little shout out to our Canadian listeners, and only our Canadian listeners will get this. Elbows up. All right. Thanks for tuning in. We'll catch you next week.
All right. And Danny, you better join the party at some point here.
Yeah.
There he is. Okay.
There he is.
So
Jenny needs to join us so the 7 ladies that are watching can be. Oh, thank God we got to get to look at Dan instead of those other 2 mopes.
Yeah,
but,
absolutely.
That's what I'm here for. It's okay. The 7 listeners or watchers, hopefully. This is for you.
Yeah.
So
we have no beer to review. We have nothing to talk about.
I am dying for a beer. I've been on this diet. For listeners, I've been on this diet, and I've cut temporarily alcohol out of my diet, and I'm miserable as hell, and I'm cranky and angry, but I'm pulling it off. You know what? One day soon there will be a beer in my hand again.
By the way, I wanted to chat with you. I sent a note to Patrick and Daniel about the Moosehead Lager presidential pack. So this is, for those who don't know, a Moosehead Lager is the oldest Canadian independent brewer, and they have made a presidential pack. And let's just read it here. It's 1,461 cans of Moosehead, just enough for Canadian lagers to get you through a full presidential terms for one a day. And we were thinking about buying a pack of this and having like a Market Huddle meetup to drink it.
I love it.
Okay, but the trouble is, by the way, we can't do it. Guess why?
Is it for Americans?
Sold out. These things went 1,400 lagers. These things went off the shelf. It's done. Sold out.
Crazy.
$3,500 a beer. And then the guys on the desk, we were talking about how long they would last. Because I was like, let's buy one and just split it. Like everyone take it. But then we were having debate. How long do you think a beer lasts?
It's a couple years.
The thing is...
there we go. The Brits like gonna.
No,
I'll drink anything. A couple years old.
Depends if it has preservatives. Like for instance, steam whistle, which is just like organic things. Like literally, they can get skunky after 3 months. Like a steam whistle needs to be.
You're correct. So some beers, like a typical beer, only lasts 3 months if it's not refrigerated.
That's why Heineken tastes like skunk half the time you drink it, because it's supposed to be drank fresh, and all these places keep the Heineken on the shelves way too long, and then you get a skunky beer.
So now, but if you refrigerate it, how long do you think?
Anyway,
if you're refrigerated, how long do you think it lasts?
An average beer or one of the.
I think because
there's ones that have preservatives and stuff like that. Yeah, I would say a half a year to a year.
Yeah, I'd say 6 months. Yeah.
Yeah. So it is actually lagers and ales generally good for 6 to 12 months when stored properly.
There you go. Oh, look at yeah.
Oh no, kegs and draft beer, a few months, unopened cans. But this is the part that I thought was funny. Stronger beers, e.g., porters and stouts, can actually improve with age and can be stored for longer periods.
Yeah, because they've got a higher alcohol content.
Exactly.
It's sterilized for longer.
Yeah.
I love it.
Which is funny because Pat, you know what that is? Your English, your countrymen there, Daniel. They created beer, although maybe it wasn't beer, it was whatever, because you couldn't drink the water, right? It was a situation where people were getting sick, and they're like, oh, you know what we'll do? Let's make some alcohol. Let's put some alcohol in, and then we won't get sick. And then you guys just took it too far.
Well,
polluted the whole world with this stuff.
I mean, unfortunately, what actually happened was that this is how gin became a thing. Was that the Dutch king came over, removed the beer, so they taxed the beer, and then they had nothing to drink, right? So they then tried to copy what the Dutch people were doing with gin, and they would basically make bathtub. So there's a few brands called like Bathtub Gin and Tomcat Gin. The bathtub gin refers to the bathtubs that they would fill with booze, and then people would go and they would, with their cups like they would do with ale, and drink the gin. And the tomcat one was that there was a cat that fell in, got sweet, and people were loving the taste of this gin. And then at the bottom realized that there was a dead cat at the bottom. But this is where Mother's Ruin becomes a thing, because everybody was so shit-faced every single day that there's a famous picture of people just drunk in the streets because they were drinking gin the same way they would. Yeah. Good old Britain. That's what I say. Come on.
Good old Britain. Were you around for our Dawson Toe discussion?
No. No.
Patrick, you remember it, the Sour Toe Cocktail Club?
Yeah, I think I remember a little bit.
Remember? Okay, the legend, here, I'll just tell you about it. It's in Dawson City, up in northern Canada. The legend of the first sour toe dates back to the 1920s and features a feisty rum runner named Louis Lincoln and his brother Otto. During one of their cross-border deliveries, they ran into an awful blizzard. In an effort to help direct his dog team, Louis stepped off the sled and into some icy overflow, soaking his foot thoroughly. Fearing that the police were on their trail, they continued on their journey. Unfortunately, the prolonged exposure to the cold caused Louis' big toe to be frozen solid. To prevent gangrene, the faithful Otto performed the amputation using a woodcutting axe, as one does, and some overproof rum for anesthesia. To commemorate this moment, the brothers preserved the toe in a jar of alcohol. Years later, while cleaning out an abandoned cabin, the toe was discovered by Captain Dick Stevenson. After conferring with friends, the Sour Toe Cocktail Club was established and the rules were developed. Okay, so let me see if I can find you the rules. Okay, you go down, you purchase a shot, you pledge the sour toe oath, and then you watch as they put a toe into your drink, and then you have to drink it.
With the toe in it.
With the human toe in it. And this is real. And they say, this is the important part, the most important rule. You can drink it fast, you can drink it slow, but your lips have got to touch the toe. We should have a market huddle meetup at Dawson City and go to the Sour Toe Club.
All right.
Would you do it?
I would do it.
Patrick would do it.
I would do it.
It's the human part of it. Like I could do, like if you told me it was a pig toe or a cow toe, I'd have no problem. But it's the human.
It's the cannibal in you. It's the cannibal.
It's like it's just taking it a little too far. And listen, someone swallowed the toe once, and it was some guy, and then so they had to get more toes, and then people sent them in, and they got extra toes. Anyways,
they got extra toes.
Come to Canada, everybody.
Well, where did they get those toes from, though? That's what I want to know.
No, I think it's like when people lose a toe from like the same way that the brothers lost, one of the brothers lost.
So you get to donate your toe?
Yeah, like so Daniel's never heard of frostbite. He probably doesn't even know what it is.
I know what frostbite is. Come on.
I know what frostbite is. Have you ever had frostbite? Have you ever been at school when some kid comes and he's not wearing a toque and he's basically his ear has gone black?
Yeah, and they flick it, and it's really painful, and that's what we.
Well, no, when it goes black, you don't flick it because that guy is he's losing an ear. I remember there's a kid in my class that basically his ear went black. It was black for 3 weeks, and I can't remember if he lost pieces of it or not. But yeah. Anyways, on that happy note, everyone have a great week. Thanks for tuning in. We'll see you in a couple weeks. Elbows up.
Cheers, everyone.
Elbows up.
Cheers, guys.